Sofi Technologies is scheduled to report quarterly financial results on Tuesday, April 29th, 2025. Investors are curious if they should buy this stock before the company announces earnings. I'll answer that question in this video. I'll also preview what investors should look out for from the company when they report earnings, and I'll reveal again my discounted cash flow model, my proprietary discounted cash flow model, which calculates a fair value for SoFi's business today. I'll do all that and update the buy recommendation for SoFi stock in this short video. So let's get started.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right, so let's start with the management's outlook for 2025. Of course, they gave this guidance 3 months ago before all of the disruption from President Donald Trump's tariffs were announced. Management said that in 2025, they plan to manage towards an incremental EBITDA margin of 30%. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And when the company said that, I took that to mean that they're going to reinvest more of their earnings into the business. They have been growing profitability significantly, and I think management in 2025 was hoping to reinvest more dollars into the growth of the business on the top line rather than allow those increases in revenue to lead to more profitability. Interestingly, management was forecasting in 2025 real GDP to grow between 1 to 2% in the United States. Now, that outlook was before, as I mentioned, President Donald Trump's tariffs were announced. This is one of the big things I'll look out for from the company's management team if they're revising this outlook for 2025. Are they going to narrow the range instead of saying 1 to 2%? Are they going to say 1 to 1.5%? Or are they going to downgrade the range instead of 1 to 2%? Are they going to say from 0.5% to 1.5%? Because certainly the tariffs are going to be a drag on growth in the United States. Tariffs are usually contractionary, meaning they limit economic growth because the price of imports will increase because businesses will need to adjust to changing circumstances. So they will need time to evaluate, analyze, and then determine the actions they will take. And in these cases, they're not undergoing major expansion plans. They're not hiring tons of new people. They're waiting and they're evaluating, and that leads to contractionary times. They also expect a continuation of normalized credit spreads across capitalization markets and stabilization of consumer credit. That part as well, I'm very curious about. Does SoFi take a new look at the consumer for 2025? Do they reevaluate where they think the consumer will be this year? Do they think the consumer credit situation will worsen? Do they think there will be an increase in defaults as a result of the macroeconomic uncertainty? And that's a big deal for SoFi because they do a great deal of lending. And the lending that SoFi does is primarily in the riskiest part of the lending market in personal loans. So if SoFi's management team expects any hint of trouble in the lending market, in the payments market where defaults are rising, they're likely to pull back in lending in that category. Now, one bit of good information we already got about a week ago was from one of SoFi's third-party lenders. They increased their commitment to purchase these loans from SoFi by several $billions. So that was an indication that at least for third-party lenders, the demand for these loans remains robust. So far, these lenders haven't seen deterioration in the credit markets, which is great news for SoFi. SoFi also said for the full year 2025, they expect to deliver $3.2 billion in revenue, which would be about 23 to 26% growth, with adjusted EBITDA of about $855 million and the adjusted EBITDA margin of 30%. So the number that's most at risk here in my opinion, is the adjusted net revenue number of 3.2 billion or a growth of about 24.5%. Will they revise that growth lower? Is the question mark. I don't think they will revise this growth number higher because, like I mentioned, tariffs are not a positive thing for an economy. They are a negative thing for an economy, at least in the near term. And then longer term, question marks remain as to the outcome of the tariffs. But near term, they will certainly pressure economic growth. And so, will SoFi downgrade their revenue forecast? I'm curious to see what management thinks of that. Now, SoFi's management is notoriously conservative in their outlook. I remember in 2024, they were forecasting an 8% decrease in lending revenue. In 2024, lending revenue actually increased for SoFi rather than decrease, which is what they were forecasting. So I expect this 2025 outlook was conservative to begin with. So if they are to downgrade this forecast, it would really be a sign that growth is slowing for the business and they do see tangible difficulty in their prospects because they're already conservative with their forecasts. Now that we looked at the preview for what investors should look out for, I wanted to share with you my valuation for SoFi stock. The intrinsic value per share I have calculated is $20.33, and the current market price is $11.18. So I view SoFi stock as being significantly undervalued at current market prices. So to answer the question, should you buy SoFi stock before it announces earnings or after it announces earnings? I think the stock is undervalued enough where you can buy before it announces earnings, but be aware that there's going to be an increasing level of risk. There's already a high level of risk with an earnings release, but this earnings release for SoFi is going to have perhaps 50% more volatility than prior earnings releases because of the added uncertainty about how tariffs are impacting the consumer in the United States. So, if you're the type of investor that's risk averse, you can maybe split your purchase in two and buy half before and half after earnings, or you can wait until after earnings to make your entire purchase. In that case, you would be taking risk of the upside, right? You're taking the risk that the company announces great earnings results and the stock price jumps and you're buying at the higher price. So you're always taking a risk around earnings release. If you buy before the earnings, you're taking the downside risk, meaning that the stock price could fall by 20 or 30% following the earnings, and you'll lose that much of your money. And then if you buy after, you're taking the risk that the stock price jumps by that much, and you're buying the price at a higher valuation. When you split your purchase in two, you're essentially having that risk. You're decreasing the risks on the downside and decreasing the risks on the upside, which is why in most cases, that's the strategy I recommend around earnings releases when I have a stock rated as a buy, which I do have SoFi stock rated as a buy.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.